All right. Good afternoon, everyone. Rich Swerbinsky with the Mortgage Collaborative here again with the Rundown with Rob and Rich, our bi-weekly look at all the things going on in the mortgage industry every other Friday at 3 p.m. Eastern. And before I introduce our special guest, Rob, good to see you.
Good to see you too. And Rich, have you noticed Tracey's already like pulling her hair back? She's putting us to shame.
It's distracting.
Did you notice that, Rich? I don't know what the deal is with the hair.
Listen, you guys have it lucky with your hoodies and your short hair. It's. I don't like looking at myself while I do this.
Do you notice my letterboard, Rob? No comments on the Chrisman for FHFA. I don't know if your eyesight, you could pick that up, but I wanted to put that in there for you. So.
Yeah, FHFA.
And any truth to the rumors that I heard through the grapevine, you took all your GameStop profits and put it into the streaker outscoring the Chiefs, more touchdowns in the Super Bowl.
Yeah, double down, paid off big. I'll be able to retire in 20 or 30 years on the payoff.
There you go. All right. With that, we'd like to introduce our special guest, our sponsor for this episode, and no pun intended, a great partner of TMC, Partners Credit, Tracey King-Danadio. And, we have a pretty simple way that we pick our preferred partners with the Mortgage Collaborative. We ask our members who they're having the best experiences with. It's, novel, but simple. And that's how Partners came to us. They've been partners with us for at least a couple of years now, and a lot of happy TMC clients. And one of many things we like about Partners is less like credit reporting company, but more data company, and doing some cool things with the way they use data and help our members out. And Tracey, glad to have you as our co-host this week.
I'm super excited, slightly nervous, mainly never know where Rob's going to come with the next question. So I'm excited for that, but we're super excited to be here. And as you mentioned, a lot of people associate us as a CRA. We are, but it's really the beginning for us. And we really appreciate the time with the Mortgage Network, mainly just the extraordinary conversations you're having with lenders, with people leading the way with their technology. So with us, we've operated on our own platform. So while we're happy to provide our customers with credit verification data, we're always listening for ways to improve and enhance the experience. So, what data is actually needed? What isn't? How can we enhance it? And there's just so many options out there right now for lenders. So we've really been working on having these conversations and consolidating that data and making this experience for everyone as simple and dynamic as possible. So that's done by working with both the lenders and the vendors as well. So that's why we love the Mortgage Collaborative. It's been such a great opportunity to really hear what's happening in the industry and work with our fellow vendors too. There's so much opportunity there. So thanks for having me.
So I'm going to immediately derail this conversation.
Great.
Tracey.
Is my hair bothering you again, or?
No, although I am jealous. So I mentioned to a couple folks that you were sponsoring this, and they thought that was very neat and very good of you. They quickly nicknamed the session "Beauty and the Beasts." But that aside, we were talking about before we began this morning. We were talking about something that I was hoping that you would educate me more on, and hopefully the listeners, in terms of who owns their own credit data. Who owns that data? And maybe you could spend just a little bit of time on that, and then Rich, you can go on with the agenda. But I think that's interesting. I think it's good for originators to know, because they probably are asked by their borrowers, what this credit report, who owns that? Where'd that come from?
Right. So it's, why CRAs like myself exist. It's to kind of create and resell the data that we're getting from TransUnion, Experian, Equifax. What information they hold and store, that's determined by what creditors are delivering that data to them. So once we have So credit and that file that needs to be pulled, we're reaching out and pulling back that raw data from the 3 bureaus. Similar to why and what we were kind of talking about before, the LO isn't able to go directly to the bureaus because we may need to make sure that that data isn't compromised. So we're not in charge of any of that data. It is coming from the bureaus. All of them report it in slightly different ways, from bureau remarks to even the actual payment history can be different through all 3. Some is reported to all 3 and some is only reported to a couple. Again, that's based upon the creditor and how they're sending out that data. So when we bring it back, we're looking at that raw data, and that's what's being sent to the GSEs or any kind of underwriting service you use. They're looking at raw data, not the credit report that you see in front of you. They're reading that data as it comes from the bureaus.
All right, thank you. Take it away, Rich.
And this is the Rundown with Rob and Rich. For those of you just logging on, special guest Tracey King-Danadio from Partners Credit. And as always, want this to be interactive. Any questions, comments, thoughts, jokes, anything anybody has, please feel free to pump them into the chat or the Q&A, and we'll voice them aloud. And Rob, unintentional but excellent segue, because I wanted to start out talking about credit. After you terrified every credit union employee in America earlier this week by saying that the government was going to be taking over the credit union system, then you terrified even more people by noting something that was a really glossed over part of the Biden housing plan that's been out there for a while. And that is the potential of the CFPB government, maybe taking over credit and credit reporting. And you had to get a lot of feedback from first credit unions and then just the broader mortgage community this week on that breaking story.
Yes, well, we all make mistakes, right? Except I don't know what I was thinking about, but yeah, we were talking about credit bureaus, and there's a difference between a credit bureau and a credit union, obviously. And I flubbed that up, and I admitted the next day that I flubbed it up because I'm not gonna cover it up. But I did hear a lot. There is a lot of conversation out there. It's not as if we need more big government necessarily in our lives. And I received all kinds of emails ranging from they shouldn't do that, all the way to some really extreme examples of, well, what's to stop the government from doing the same thing with Fannie Mae and Freddie Mac and every mortgage company out there? Why don't we just get our mortgage from the government? So it really struck a nerve with a lot of readers out there in terms of if the government does away with the credit bureaus, not the credit unions, but the credit bureaus, what will happen? Is that better? Is that worse? What does that imply for the rest of the industry? And I know Tracey has some thoughts on trending data and so forth. So at this point, I'll turn it over to Tracey and give us the inside scoop on what credit folks are thinking about that.
Well, this is something, it's been changing, and talks of change have been going on for quite some time. I mean, last year, the big talk was that it was going to go down to 2 scores, and maybe they were going to eliminate 1 credit bureau, and what that would look like. What's interesting, and as you mentioned, you talk about who's holding that data and how is it getting transferred to the credit report. If it's controlled by one entity, what does that look like? The bureaus now, and the scoring method that they use, the FICO scores, that is approved by Fannie and Freddie. So those scores and the scoring model they are using haven't been updated for quite some time. So there's newer versions of how to score and what that looks like, but they've opted to kind of keep the version that they've been using. The other thing too is that trended data, when that came out, lots of our customers don't even look at that. They hide it on their credit report, but that data is still being submitted now to Fannie and Freddie. And they're reading that, and they've said, we're not using it in any kind of derogatory way. It shouldn't hurt anyone, but it has the ability to help someone. So we can look and see at how they've been making their payments, if they're different payment schedules of like what they're doing with their payment schedule. Are they paying the minimum? How much more are they paying? And in using that as a way to kind of review a customer and how they're a borrower, excuse me, and how they're making their payments. So there's lots of different ways to be able to evaluate data that they're poised to do. Do I think that it's worth taking a look at of how we score things? Yes. I don't think taking in a completely opposite direction is the answer. You still need to have an aggregator of that data. You still need to be able to store it. But, you know, talking about scores, and I've talked to a couple people about this, is, you know, there's an ability to manually underwrite a loan with someone that has no score. We're also talking to people that, as we all know, this last year, suddenly the investors, their score thresholds have completely changed when they needed to look at the loans that they were going to give. And you have a lot of people that come in the door, and if they don't hit a certain threshold, we can't do that right now. I do think that there's the ability to have a middle ground somewhere. I don't think it has to be one extreme or the other, but the tools are there. It's just reevaluating how to use them, I think, is the big question.
Yeah, I'll say that I'll put on my libertarian hat here, or independent hat, or whatever hat it is. But, you know, a lot of people will tell you that they've never been impressed with the way the government does things, and that the government rarely does something better than private enterprise or a private company will do it in a more cost-effective way. And on top of that, I know the CFPB a few years ago took over HMDA. And now if it takes over, you know, credit, or quote, takes over credit, you're dealing with an institution, a government agency that where the head of it is subject to the whims of whoever's president. And so I don't, to Rich's point, it's not a particularly wonderful topic for us as an industry, or probably anybody else who uses credit data, credit reports. I don't think they want it concentrated with the CFPB, but, you know, who knows? Who knows?
Well, and someone, you know, in talking about misinformation or errors on the credit report, I read a response that someone had sent to you as well, is that the bureaus aren't necessarily the ones coming up with the errors. It's starting with the creditors reporting that. So that can happen one way or the other, which is very true, is that there has to be someone giving that information and storing it. And how are you going to do that? But I don't think that's the question. It's the question of how are you looking at those scores and what does it mean, or looking at the data. So Vantage Score was basically all three bureaus coming together to try to create this common score, so it isn't differing from one bureau to the other. That's not used in our industry. There's several different, I mean, I think TransUnion has something like 52 scoring models. So wow. There's a huge pool, but we don't have that information is proprietary. So within actual scores, there's different score cards. It's super complex, and one that we can only try to find out or figure out what it means. But potentially, if we can lift some of those layers of what it means to have viable credit, and work with people earlier on to educate them of how to have a good score, it's complicated for the everyday consumer. For us in the industry, it's so normal now to talk about it, and it seems like everyone should know, but then I still run into people where it's like, yeah, no, don't pay off your credit card every month. To them, they're being a smart consumer. They're listening to people that's like, don't have credit. Well, as we all know, you walk in, you need credit. Keep your balance at, 10 to 20%. For some people, that means keeping a balance of $10. That could be kind of hard to do and maintain. So it's a game, and you want it to be something that people are rewarded for. So if you can look at that trended data, the data of how are they using their finances? How are they in a situation? I think that, that opens things up, as well as, medical collections, or talking about when are you being responsible? When has life happened? Just how forbearance doesn't impact your score. That's kind of the world around us is happening. It doesn't mean that you're necessarily not educated or financially responsible. So how are we looking at different factors on a credit report? I think that's an interesting way to think about it as well.
So you have clients all over the nation. Do they share their opinions with you about this and other topics? And do you incorporate somehow their opinions or their thoughts on doing business into what Partners is doing?
100%. You know, we have it's interesting because it depends regionally what people are having to do in order to get a loan approved. I have some people that have to do a fraud report, some people that have to order a credit report pre-closing, and others that do neither of those things. It always surprises me to hear different ways that people are having to work in their lending. So kind of what I was talking about earlier about looking at different data elements and what matters in your loan process. We had a customer who wanted to know foreclosure data up front of what would appear on their fraud report so that they didn't get so far down the line with their customer. So we added that to the credit report. It's like, what attributes do you need to know as a lender of how you can move forward with this borrower? And then on the other side of that is, you know, when the market isn't so hot and you have your pipeline so backlogged that you're trying to get through this, there's the borrower that needs someone to kind of walk them through and talk to them about improving their score and how to get there. And there are other tools that we utilize to really help our customers navigate that. So there's some lenders that are focused on heavily refi. There's some that's more purchase. And then there's a middle ground of people that really like working on the more challenging files with a thin credit and will do the manual underwrite. And there's ones that don't. So we're constantly looking at that.
We welcome any of our attendees, questions, comments on this critical issue. Please feel free to chime in the chat or the Q&A. And had a question that came in that really cuts to the heart of what my next question was going to be. The comment is, some remarks have been that credit scores are not colorblind. I disagree, but can you comment on it? And you know, I think that's really the heart of, you know, what the Biden administration is looking to do is to be sure that there is a level playing field, fair access to credit for borrowers of all race, color, creed, age, demographic. And the implication, which is justified really, is that it's this black box. Like you mentioned, Tracey, you could pay off an account and it can hurt your credit score. Opening new credit cards can help it. Other oddities of the credit system that just confuse people because it's not transparent. You know, even more so now, these last 7, 8, 9 years with the agencies and their loan level delivery fee systems where you have these FICO buckets, right? Where if you're 719 versus 720, I don't know, you know, back in my cap markets days, that was in some cases a half point or a point difference on the deal, which 1/8 and quarter rate or a point out of your pocket. Is there a way to keep the system as is, but make it more transparent? I don't know who I'm asking that to, maybe to myself. But
I mean, that's a challenging question. And I do think, you know, without being too polarizing on it, I do think there's validity to it as well. As mentioned before, I think that you hit it really where there's so many counterintuitive things about credit that don't make sense to a lot of people. And especially if you're looking at dependent on demographics or opportunities, what kind of loans people can get. You know, Experian started doing something like Boost last year or a year or two ago, where you could have non-traditional credit. You could ask to have it added to your credit report. So you can look at some of these non-traditional credit lines, but it doesn't help anything. So it's on your credit report, but it doesn't impact your score. I think that's worth looking at, is that if someone does pay their gas bill on time, where it could be shut off, or there could be issues with that. If someone is living in a lower income area and just starting to, you know, apply for a credit card and get things moving, you know, length of time that an account is on your credit report. But if we're looking at first time home buyers or people that haven't had opportunities to get their, lines of credit out there with like a, Capital One account or whatnot, you need to look at alternative methods to do that. And I think that's extremely important. And again, we're poised to do it. It's just, how are you going to then look at that data? And that's up to the GSEs really to kind of guide the way to do so. You can do that now without a score. We have people taking reports with no scores and creating a non-traditional credit report. So,
So I like to tell people that several years ago, 2005, 2007, originators would come to me, Tracey, and they'd say, I'd never loan, I'd never loan this borrower my money, but yet here's this program offered by Lehman Brothers or WAMU, or, I'm not going to throw names out there, but, they'll buy that loan. So I'm going to do the loan. And then it got to the point, the credit pendulum swung to the point where I'd be talking to originators and they'd say, I'd loan, that rich guy, I'd loan him, $300,000 of my own money. But I can't find a program given his credit. I can't find a program that will, that I can originate his loan and sell it to an investor on. So it's tough because, and then I would say, it's tough because pendulums, in this case, a credit pendulum doesn't just stop in the middle. It swings to one side or the other. And with the Biden administration, I know Rich is watching this very closely for the TMC members, and what happens with the Biden administration in terms of the economy and in terms of interest rates, but also in terms of the regulatory environment. And I think it probably will spill over into credit because, you want to give borrowers who are going to make their payments, who have the ability to repay, you want to extend them credit. And you don't want to extend credit to somebody who doesn't have the ability to repay. But, you mentioned, there's so many nuances in Experian having, 52 scoring models or whatever you said. It gets incredibly complex to the point where, we're just, as an industry, we're just trying to help borrowers get financing. And if it gets bogged down, if the credit decision gets bogged down because of nuances, that's a problem. So I'm glad Partners is incorporating a lot of the comments that you receive from your clients and taking those things to heart and tweaking things a little bit and trying to help originators help their borrowers. I think that's really neat.
Yeah, and to say that too, though, in conversations I've had, we do ultimately want to help a borrower, but there can be times in which it's easier to help certain borrowers. And I think you kind of touched on that. So there's ability to help move people forward, but it becomes extremely more time consuming. There's a lot of extra work that has to go into working with a borrower that has limited to poor credit. So, where do you start? I think that's the main question, really. And is it this overwhelming surge to kind of take it over and flip it on its head? I'm not there yet. I think that it can be worked on and tweaked. And as I keep saying, there are measures that have become in place. And to move things in the credit world, it takes forever. But there are things that are ready to look at. It's just now we have to think about who's taking the look at how we weigh these things and what does it mean, and looking at the socioeconomic impact of our lenders, our investors, these areas. I think that's kind of where I am at.
Yeah.
This is the rundown with Rob and Rich, and we've got about 15-20 minutes left here. We've been touching exclusively on the issue of potential change in how credit is run and managed in America. And want to remind everybody, any questions, comments, please feel free to type them into the chat of the Q&A. We'll voice them aloud, and had some things come in, some funny comments in the chat, supporting Rob for FHFA. Here's
that. I
one,
wasn't going to
Rob,
mention.
even though I work at a credit union, Rob, now the mortal enemy of the credit union community, I still support Rob for FHFA director or
There
the
you go.
But a question on the topic, with the potential of multiple option for credit scoring models, how would a lender approach fair lending? And that's a good question and a good segue. I wanted to talk a little bit about this because my previous life was working for banks. We went through fair lending audits my last 5 or 6 years annually. And, then we were keeping and had to produce a myriad of reports showing rate exceptions and where our applications were taken from as opposed to our branch footprint, what the demographics were of those applications. And this is something, at least to this point, independent mortgage banks haven't had to really worry about at all. And at least the independent mortgage banks I've talked to these last couple of weeks, it's firmly on their radar. One other comment that came up this week from a lender was just related to these credit, like quick credit improve and rescore, the rapid rescore type products. Lenders being leery of maybe doing these going forward, because what if you do the rescore for the 719 white borrower to get them to 720 to lessen a loan level delivery fee, but you don't for the 619 African-American borrower that needs to get to 620 or 640 for an FHA loan. So Tracey, I'm going to start with you just to get your thoughts on some of the fair lending tentacles of potential changes and credit and CFPB, and if that's anything you've heard or experienced either recently or in the past.
Yeah, I mean, even with our customer base, there's a wide range of what people will and will not do. I mean, we have seen people being more restrictive on credit expert, which is the tool to help improve a borrower's score. And exactly to your point is, who are you offering it to? One, it's for FCRA purposes, you can't pass along that fee to the borrower. It has to be something that the lender eats. But when are you offering that up, and how are you doing that? So a lot of our banks have opted to kind of pull back on the credit expert for fear of what you're talking about. But I think it also, I do have, a few main customers, and one that's actually a bank that is really heavily invested in it, but it's very time consuming. And so we've seen people, rather than leave it up to the LO and have one-offs of, maybe this LO is more willing to work with a borrower. We've seen a lot of our customers kind of have a focus group that looks solely at this. So they have created internal guidelines of where they'll do that for on every file, or where they'll present an opportunity to improve the score. But there has to be consistency with it. So one thing that we have is a tool called Credit Assure, and that's just when you pull the credit report, it'll show a potential score increase right away. And so you don't have to actually run the scenario, it's right in front of you. From that, you can create guidelines of, is there, what's the threshold for improvement? But you're right. I mean, it's a very slippery slope, and that's something that you need to look at and make sure that, as of everything else, you need to have guidelines of what you're offering your consumers and how you're presenting it to them. And then, it's always risky for us because there's a difference between providing options and credit counseling or credit repair. So my biggest takeaway or what I would suggest is creating your own team internally. One, because a lot of people are misusing these tools and don't know how to really get it to its full potential. Two, it's a really great resource for helping improve the customer experience and loyalty from that customer of what you were willing to do to work with them. But three, and to your comment, is, evaluating how you're managing that and who is managing that. And again, you have to, no one likes to have to micromanage all of these things, but it's worth taking a look at. If it can improve on retention, if it can improve on the rate that the borrower experiences, then it's also worth looking at putting some procedures into place to make sure it's done properly and focus on the right people.
And if Rob is appointed FHFA director and it just eliminates all the loan level delivery fees, this issue goes away.
Done and done.
Rich, I don't think that you have the same ability to repay a loan than say Tracey does. So yeah, we've got to keep those loan level price adjustments. And by the way, Rich, I'm surprised you haven't told the listeners about about your move toward buying your own place and the GoFundMe site that you set up in order to come up with your down payment assistance program. So,
Well, it's I think Tracy
but
mentioned like,
Tracey,
lenders, or no, you mentioned, Rob, lenders like that wouldn't like lend their own money, but would lend their lending institutions money. I had a degenerate high school buddy that when he got approved on the Fannie Mae My Community mortgage, I'm like, it's over. There's no
I'm
chance.
all my buddies, degenerate buddy. Anyway, I'm sorry. Go ahead. What were you saying?
I was just joking about a high school friend of mine that once he got approved for a mortgage, I knew it was over because I knew I knew he was not going to pay. Oh, no, seven. Seven.
I wanted to ask Tracey as a little bit of a follow-up there. I know Partners is very tuned into the VOE process and incorporating that. And so maybe you could tell our listeners briefly what Partners is doing in terms of VOEs, because with COVID, of course, that part of the industry has moved around a little bit. So where do things stand now, and what are you guys doing about VOEs?
Yeah, I mean, it was definitely a very tricky year for verification of employment and trying to get that information with employers, either, totally shut down or delayed. And we were the last thing that they wanted to do. And also pricing increases all around for third parties to get that data, that store that data. So we're looking at alternative methods and how to get that and not having to rely on third parties. So what's newest lately is moving it more to a digital experience as well. Similar to the verification of assets or deposits, there's now a VOIE in which the borrower would supply their banking credentials, and you can get in and look at pay stubs and the payment history that they've received. So I know that that's being worked on to have approval for hopefully day one certainty down the line if that comes back for that employment piece. But looking at different methodology of, how much do you have to get your borrower involved? And it's always been very interesting and tricky because as much as we're doing digitally and inputting your social security number, one of the slower moving things to get going is the verification of asset, because as soon as you're asking for credentials into your banking system, people get a little hesitant. So that's another way in which we as in the industry and as lenders and essentially you're giving them guidance along the way. It's important to look at different ways to help that experience. So some, I don't want to get them involved. I don't want them to have to ask their employer. Okay, well, there's other methods to go about this, but you're going to have to give them some comfort and ease of knowing how, one, it'll be a much quicker process. Two, all of these things are so secure and have been probably more so than I know a lot of people that'll just, oh, you need my W-2s, I'll just email that right over to you, and they don't password protect it and don't recognize how dangerous that is versus a system in which you can collect this data and secure portals. It's just easing them into that and talking to them about that. But so there's lots of movement in that regard, both to reduce pricing and then also with timeliness. Yeah.
A VOIE, because if there's one thing this industry needs is
another acronym. Don't even get me started. I think I sleep talk with acronyms.
We've got about 10 minutes left with future FHFA Director Rob Chrisman and Chief Operating Officer of Partners Credit, Tracey King-Danadio. Had a couple questions come in the Q&A. And if anybody has any other questions or comments, this would be the time for them as we wind down here. This one for Tracey: what is your recommendation for someone in college or just starting in the workforce as to what they should do to establish credit that is worthwhile for becoming a first-time home buyer 6 to 12 months down the road?
Yes, 100%. Even for employment purposes, even to get a rent now, they're pulling your credit and looking at it. And if you have nothing there, it's difficult. Even for us in our business, we have to pull someone's credit to look at, if you're in our industry, you have to make sure that there's not derogatory, but it's extremely important. So whether it's becoming an authorized user on your parents' credit card or starting off real slow and getting a Target credit card or a Kohl's credit card, you want to start that process slow. And I would suggest, recommending to them that they keep open that credit card and have that limit be on the lower side. You don't want someone going in too high, and talking to them about that balance to high credit ratio. You want to keep it at about 20% if possible, and get them in the habit of, just put a thing on that here and there. But as I mentioned before, it's not just how many accounts you have established, it's also looking at the length of time. So if you're in college and you can get a small credit card, you really do need to start to do that early on. And I recommend having a couple of them, because just by having one most likely won't generate a credit score.
And then another question about just damaged credit due to fraud. Is that something you're seeing more of? Is that something that Partners offers solutions for? What does that climate look like these last couple of years?
Yeah, so there's a lot of solutions now. It's, as we're talking about errors on credit reports and finding things, we all have more access to our credit report than ever before. There's so many different avenues, and not associated with us, but for people that don't know, there's a website. It's www.annualcreditreport.com. And there you can pull your credit through each bureau free once every year. So you can see and you can look at all your information there, and you can dispute anything that shows up on your credit report. I will say I see a lot of disputes now showing up on credit files. And I think some people heard that, a dispute, it doesn't impact your score as much as possible. So they might have justifiably gotten a collection, but they'll dispute it because they think that that will help their score, which it might, until it's time to get that loan done. And you now as the lender have to verify that information and it's real. And then we have to remove the dispute, and then the score drops. So I'll say that there's more access now to being able to change that information, but the bureaus are required by law to respond to any kind of dispute or concern over something on their credit report within 30 days. So there's a time frame on that in which they have to look at it and respond. So we help facilitate that if there's a borrower that needs information on how to reach out to the bureaus, or if there are, inquiries that show up on their credit file that weren't done by them, then yeah, that's part of our responsibilities to show them that. Also, if a credit report was pulled through us and the borrower wants a copy of that, we're required to also provide that to them so that they have full access.
Excellent. Let's see here. We've got about 5 minutes left, and I had a whole bunch of topics that I wanted to get to, but Rob, you lead us the next direction here.
No, we need to keep in the same direction because I've got another question for Tracey.
Oh gosh.
No, so
I want to hear your voice, not mine.
No, so I'll tell you a story, which is my my usual story. So years ago, I forget the hacks that got into the credit bureaus,
Mhm.
and they offered. So then the credit bureaus turned around and offered free credit reports or monitoring your credit,
Right.
free services for X number of years, and so now, like every day, I receive an email. Oh, your credit score has changed.
Mhm.
Click here to see what happened. Your credit score has changed. Click here to see what happened. To the point where I don't click there anymore because I don't care. Because
Right.
I'm not getting ready to buy a house, and I'm not getting ready to buy a car.
And what credit score are they showing you? That's the other question.
I think it's Experian. I don't even know. I don't even know.
Right.
It's been a while, but I delete the email, delete. What is the current status on the hacks that took place a while back, and people monitoring their credit scores and so forth?
Yeah, so there's monitoring activity. I believe what you're speaking of is the Experian or the Equifax breach that happened.
Right, Equifax, you're right.
Yeah. And so they offered a service that would, I believe it, and they could freeze their credit report. I know a lot of people are opting for that right now, where you can put a freeze on your file so that when your credit's pulled, it won't go through. No inquiry is posted. They can't have access to your data until you actually contact the borrower, contacts the bureau and says, yes, please lift the freeze right now. And then we're able to access that data. We see that happening more and more every year where people are doing that. But, in terms of like your credit score changing, if you ever watch House Hunters, if you've seen kind of the meme that goes around where they're like, oh, I'm a first year teacher. I make 45 grand a year. I'm looking at this house. I'm so excited to buy for $750,000. It's just, what's happening that someone could afford it? That's like your score changing on the internet, where you go in and you look at your score and it tells you have a 730. Well, that's not a mortgage FICO score. So then there's a very sharp turn when they go in and walk to a lender and you pull their credit and it's a 620. Well, I just looked at my credit score online and they said I had a 720. Well, that's not a mortgage related FICO score. It's very different and it's very challenging. I know a lot of lenders can appreciate that conversation with the borrower of saying, well, what kind of credit did you pull for me? And don't understand that there are several different models out there. So it does change because your creditors are reporting to the bureaus on a monthly basis. So any kind of change in your balance will impact your score. Any kind of inquiry, it takes 30 days for that to impact your score. So there is a constant ebb and flow of what that looks like, and different scorecards that you fall under, the length of time since you've had a derogatory, that can fall off in a month and jump your score 20 points. So there is truth in that. It's constantly changing, but the question is to what degree, because of ways that they're evaluating it. If it's telling you your score went up, it most likely is going up a little bit, but it might not have the same impact on the credit reports that we're looking at in our industry.
Couple comments in the chat from people that have mortgages that are owned and serviced by some of the big money center banks, saying that they get reports when their credit score goes up or down from their existing mortgage holder, which seems like a nice service. But yeah, I think in a nutshell that, it'll be interesting to see what happens here. I think there'll be a lot of resistance to moving credit under an organization like the CFPB that, still is loosely overseen. But I could see, I do think we will see, a big push at the least to have more transparency to the
Sure.
credit scoring process. And I think that's something that we're going to see, certainly something that we'll be keeping an eye on. And, another way to help qualify as well is, you just move all these columns I'm reading about how we're going to have these huge population migrations from places like Rob's hometown in San Francisco to hardworking Midwest cities like Cleveland. You can get an entire street block for $750,000 in Cleveland, and lower loan amount, easier to qualify. So everybody moved to Cleveland.
There you go.
Go Browns. I think we've run out of time, Rich.
Yeah, I won't point the camera out my window to show you what it looks like in Cleveland on February 12th, because that's why everybody's moved away from Cleveland. So.
Well, I'm in Chicago. It's about the same. Yeah.
That's right. You're in Chicago. So, and Rob is actually in Lake Tahoe with Fredo Corleone. Is that him in the background in the lake there?
Good memory. Good memory. Yeah, that's I ride my bike by there often, as a matter of fact.
With that, we're out of time, but I want to thank everybody for joining us on the Rundown with Rob and Rich, and certainly want to thank our friend and sponsor, Chief Operating Officer Tracey King-Danadio of Partners Credit. When we said you were going to be the co-host, you didn't know you would be speaking 41 of 36 minutes. So.
A pleasure. I'm sorry for all that tuned in for you guys and got a lot of my voice, but I appreciate it, and I'm glad we were able to answer some of these questions.
Absolutely. Yes. A lot of nice comments in the chat about Tracey, about Cleveland, about the show. And we're here every other Friday. 3 p.m. Eastern for the Rundown with Rob and Rich. And we'll be loading this episode, as we always do, to our YouTube channel and packaging and delivering it as a podcast for people to listen that way. So with that, thank you very much. Have a great weekend, everyone. And we'll see you in 2 weeks. Take care.
Thank you.